You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com, and co-hosts Alex the Viceroy Jacobson from Options Express, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com. The Option Block is brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
All right, everybody, welcome back to the Option Block. We are, of course, everyone's favorite bi-weekly choice for all things options related. My name is Mark Longo from the OptionsInsider.com, the mothership, if you will, from whence all of our content flows, as well as the ever-expanding, ever-exciting Options Insider Radio Network, a new show on that network. Head on over there and check it out if you haven't done so already. It's pretty cool stuff. And where can you find that show? Well, of course, everywhere you can find this fine program, including the OptionsInsider.com. All of our shows are available there. Just click on the Insider Radio Network tab up there. That nice overlay pops up with all of the shows, up to, I believe, 13 now up there. You click on all of them. All the archives are available up there, so you can peruse probably close to 1,000 hours worth of content now up there at any given point. So there's a lot there for the picking as you guys surf on over there. And, of course, you can find them iTunes, Stitcher, Aha Mobile, wherever you find your finer podcasts. Some of the geekier among you out there like to just take the RSS feed, pull it into your podcatcher of choice. Hey, we support that too. We'll give the RSS feed. Whatever you guys like to do to listen to the shows, we will support you. And of course, for those of you who don't want to go through the hassle, we built our own mobile app available for iOS, Android, and the Fire OS. You can instantly stream all of our programs on the network. I have to make sure the new show is in there. If it's not, some of you have asked about that, so I'll have to make sure that it's included in the mobile app. If not, it will be coming shortly, as well as, of course, all 300 plus episodes of the Option Block and everything else we've ever done on the old network. You can listen to all of them, stream them instantly, wherever you have signal. And then if you don't have signal, or you're going to go somewhere you don't have signal, well, maybe you download a few episodes to listen to on your commute or on the plane or the train or wherever you're going to be. And while you're listening, you say, hey, that Andrew guy, he's really kind of crazy. I need to let him know what's what. Or you want to say, hey, I really like what they're talking about, or I have a question about that. Let us know. There's no shortage of ways for you guys to do that. And we made it even easier for you. We baked it all into the app. So Facebook, Twitter, email, it's all in there. Even voicemails, all can be done via the app. So no shortage of ways for you guys to get in touch with us here on the old program. Speaking of that crazy Andrew guy, he is joining me on the old program today. Mr. Rock Lobster, welcome back to the show, sir.
Always good to be here on the Option Insider Radio Network. I feel like I have a second home here for some reason.
Yes, you're starting to become quite the network stalwart. Listeners, if you're checking out our new programming, Andrew is featured very prominently on that. It could be a good thing or a bad thing, depending upon your opinion of the Rock Lobster. But we tend to like him over here, so we've groomed him into his own program, which is...
I tend to show up on time.
Yes,
which helps.
That helps.
Part of life is showing up, I think, which is important.
Giovinazzi, you come from the fascist Italian era where the trains ran on time, and so
exactly. Exactly.
You're used to that. Speaking of showing up on time, Uncle Mike Tusaw usually doesn't, but today he's actually on time for the beginning of the show. The Skype gods are hopefully smiling upon him. So let's welcome him also to the program today. Uncle Mike Tusaw from RCM Wealth Advisors, RCM Asset Management. Uncle Mike, welcome back to the show, sir.
Always a pleasure to be here, as it is every Monday and Thursday on the Option Block.
I was going to say, wait a minute, is it Monday? Did I go back in time? What happened? Did I lose a week? What's happening here to me? You messed me up there, sir. It's like my Apple earnings tricks that I play on you all the time.
I'll still never get even with you for that. I don't see how I could.
And listeners, I mentioned, unfortunately, we are Viceroy-less, as he is indeed recovering from surgery, but not too major, listeners, so don't worry. He'll be back shortly. He's just undergoing the old mandatory disability period in which he cannot even participate on the show. It is verboten. So we'll go Viceroy-less for a little bit, but otherwise, we're still going to bring you all the same fun show you're used to, just without a few of the 10-year macro discussions and without some of the wet blanket stuff that Alex likes to throw into the show on a regular basis. All right, with that said, we're going to keep on rolling right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, listeners, you know what that sound means. It's time for the Trading Block. If you're new to the show, this is indeed the portion of the program where we break down what was catching our eye, what was going on the old street today, and was a bit of an upside move today on the old street. S&P closing up about half a percentage point, or just a hair shy of 10 handles to close at 2011. So we're back north of the 2000 level here in the S&P. The Dow up about 100 handles and some change to 17,266. The Q's up about 0.75 of a percentage point to 100.24. And the VIX cash taking it on the chin a little bit, as you might expect today, down about a little bit under 0.75 of a percentage point here to just about 12 even on the old cash side. So VIX cash taking it down, market ticking up. A lot of interesting things. Of course, we saw earlier this week the old FOMC bucking a lot of the trends, a lot of the predictions that they were indeed going to raise rates, and said, you know what, we're going to stay kind of in dovish territory for the foreseeable future. No more rate increase talk, at least anytime in the near future. So the market free to rally ho as a result. Even though a lot of people were thinking that this was a time, maybe, the market's rallied, things are looking good, housing's looking a little bit stronger. Maybe this is indeed the time to raise some rates, but it didn't happen. So if you're out there looking to borrow some money, you can still stay tuned to those cheap rates you've been taking advantage of for so many years now. And Mr. Rock Lobster, in addition to the Fed, a lot of stuff cooking this week, a lot of stuff cooking today. What caught your eye in today's activity?
Mostly there's two things. One is this is, I'm going to say, just the day of the revenge of William Wallace. Does he get revenge, or does the guy actually just go to sleep ever? It's sort of like, the Greeks leaving the EU, is that really good? Like the Scots leaving the British Commonwealth, and all of the intra-country, I don't know what they're looking for, I guess because they think they could run it better. Anyway, I think that puts at least personally, I think that's what is keeping volatility anywhere close to where it is, even in the 12 handle. We're not moving very much. And I just one of a couple of clients in our option pit chat, like, they don't think VXX can go down anymore. It's gone down as far as it's going to go. I still think there's a lot of premium in the futures, and I'm still trying to figure out why it's still there relative to. The only thing is this referendum, which, the market doesn't like these destabilizing, referendums. We're going to pull out of something or other. So I think that is basically whatever the last hint of volatility is kind of hanging out there. And we see tomorrow what happens in Scotland on the vote today. But for the most part, market like what the Fed had to say. Essentially, they're not buying bonds anymore, but clearly with the treasuries, without Alex here, but without the treasuries in the 3.5 range or something like that. Clearly, there's plenty of demand for U.S. bonds. So the government can keep borrowing money like, a fiend. And the S&P 500 is steaming along. I believe we have a closing high today. So
that's Uncle Mike's job there to say it's never been a better time to sell.
Exactly. So I think we continue to go higher if the Scotland thing doesn't just throw a monkey wrench in everything.
It's interesting you mentioned the Scottish referendum because we are on the eve of that as well. It seems to have become very strident over there as the debate and as the vote approaches, and it seems like it's very, very narrowly split down the middle. There's like a survey that came out this morning. They said the pro-union support narrowly in the lead, I should say, and the majority of strategists are cautiously predicting a victory for the unionists. But this is the closest we've ever seen to one of these major secessionist, movements actually taking root. And we see it all the time, the sentiment from Quebec and a few other areas, but it never really amounts to much. Here, the Scottish are actually taking it, and it's going to go down to the wire, it seems like. I know that it was much closer in the anti-secessionist camp. Recently, it seems to have evened out a little bit, so it's interesting to see how that will play out. Uncle Mike, what else is catching your eye in addition to the fact that it is indeed the best time to sell stocks in the history of the market?
Well, earlier today it was. We're about 2 pennies off the all-time high in SPY. Oh, after hours market, we are actually at all-time highs right now.
There you go. Hit the button. Take advantage.
SPY. After hours market, folks, hit the button.
Let's hear it, though. I need to hear him say it.
Well, Longo stole my thunder on it. I mean, I don't even know what the heck I should say. I don't know. All right, folks, there's never been a better time in the history of the entire stock market to sell your S&P funds than right now. We are at all-time highs as we speak in the after-hours market even. And I'll be honest, after yesterday's Fed meeting, I think there's plenty more upside. So with that being said, I think there's never been a better time to be simply long calls or long underlying and long puts. Reason being is, yes, vol is a little bit higher right now in Andrew's view, being the resident volatility expert with which he is, but with the 12 VIX and the market at all-time highs, with my opinion, a lot of reasons for it to go higher, I think that it makes sense to just be long premium in one way, shape, or form and play the upside. With the Fed saying yesterday, or with Yellen saying yesterday, that they'll be accommodative until the end of the decade, quite possibly, or they won't raise rates any more significantly till the end of the decade. I think that's just a very bullish sign right now, just saying that if we used to refer to this as the Bernanke put, meaning that Bernanke wouldn't let the market go down too much because he would do this. I think now we have the Yellen double put stupid even.
Speaking of stupids and doing things like using derivatives to swap out some underlying, you're talking about getting long calls. We saw a similar story coming out of PIMCO this week, not exactly buying calls, but a similar approach. They came out this week and mentioned that they sold pretty much most of the $48 billion they held of U.S. Treasuries in their PIMCO Total Return Fund, and instead they replaced them with $45 billion worth of futures, and that, of course, freed up a lot of money, and they were amazed at how much money they freed up by doing that, because, as I even say in the article here, futures only require much smaller initial payments than they do buying the bonds, and so they're taking that cash and buying all sorts of other peripheral things and freeing up a lot of opportunity costs that they can then turn around and invest in other products. And it's amazing. You see these large funds and making headlines doing something like this. And yet this is the kind of thing we talk about here on the show like this all the time. Granted, we don't talk about using futures. Usually we talk about swapping in options for the underlying. But still, it's amazing to see how just a little simple strategy can have such a big effect on even something as big as PIMCO. Just freeing up all that capital. It's like it was a whole new day for them over there at PIMCO. They should give you a call one of these days, Uncle Mike, and you could talk about swapping in underlyings and all that fun stuff. Probably talk about the 10-year a lot, too, because you're big on the fixed income now.
That's what it seems lately, doesn't it?
I think Alex has brought you down a very, very dark path, sir. Speaking of dark paths, there's other things afoot this week here in the old markets. Of course, I'm referring to the big IPO that a lot of you guys over there at Options Express and Schwab have been keeping an eye on lately. This is, of course, the Alibaba IPO. If all goes as planned, it should go off tomorrow here on Friday as you're listening to this, listeners. We're, of course, recording this Thursday, September 18th. And I've been reading some interesting things about this IPO of late, and certainly there's no shortage of analysis. We talked about it on the last show. People were recommending, including Barron's and others, getting long. I believe it was the 43-48 call spread out in November to spec on this IPO. If you did that right now, it looks like that isn't working out too well for you. Yahoo having sold off about $1 since then, so it's down to about the 42 handle. So if you still want that call spread, maybe you can get in at a much cheaper rate, though, like we said before, all this zealotry may give you an opportunity to sell some of that out of the money premium, because it is getting a little bit juicy out there. But that said, I was looking at some of the way this IPO was constructed, and it makes me scratch my head. Of course, this is indeed a Chinese company. They have different rules over there, different rules of engagement that we have over here in the States. Of course, the Chinese government, the way they structure these deals, they really forbid foreign ownerships of what they term to be key strategic assets. So what you have here is an IPO, one of the largest in history. I think the total amount that they're raising is about $25 billion. This guy who owns it, Ma, who owns about 9%, gets to raise about $25 billion in the marketplace. And yet, when you buy that stock, listeners, when you buy that IPO share, you're not getting a piece of ownership of the company. What you're essentially getting are the rights to the profits that are being sent to a holding company known as a variable interest entity. So essentially, you're buying a de facto option, even if you may not be aware of it here. So this guy gets to raise all this capital and get all of this PR and everything else like that, and yet they're really not divesting any control whatsoever. Sounds like a pretty darn good deal to me. Andrew, are you going to rush out and buy these shares now?
No, you just can buy Yahoo and get all the shares you want.
Yeah, pretty much. You still don't get any ownership, but at least you get a stake. You get essentially the option on their profits going forward at whatever level apparently you buy in. I don't know how this breaks down. But
how do they? You know what? It's the capital structure in China is still a little baffling. I think sometimes, like why a lot of companies, okay, they're worth a lot, they're worth nothing, they're worth a lot. It's hard to figure it out, but. Now, it would be funny to think if Yahoo actually has less ownership control than they did before it went public. So I don't know how that's working for them, but we will see. We will see how it all plays out. But we've had the debate on this. Sebastian thinks Yahoo is going to go in the tank a little bit because Alibaba IPO is kind of going to be, it's fully subscribed and mostly like Facebook. All the buyers, they got sated, and then all of a sudden, who's buying the stock? So maybe the underwriters are cognizant of maybe keeping some people in the wings that want to buy some of the stock. So who knows? Who knows where it opens? I really have no clue, but people still seem like they want it. So. I mean, a lot of funds are buying it, so push the price up.
Somehow, I have the feeling that the underwriters may have to do a little bit of defense of that price tomorrow when it comes out a little bit. Hold that line in the sand for as long as they can. Who knows? The zealots could take it north, but you're right. There's so much hype and buzz, and all these. When you get into the actual details of the IPO, it is very much an underwhelming thing. So thanks for giving me the rights to your profits. That's very nice of you. But it's just kind of interesting the way they structured this. And yet, of course, you're right. Yahoo taking on the chin today, down about $0.50 today alone. So not exactly what you'd expect going into this big IPO that's going to generate so much cash for them. So we'll see. We'll see how all this tunes out tomorrow. Listeners, you, of course, will know it live as it unfolds as you're listening to this tomorrow. So we'll keep an eye out for that. Uncle
Yahoo,
Mike,
there's a rumor about Yahoo buying AOL.
I was just talking about this with someone yesterday and about how AOL is still so predominant in the area of essentially financial transactions because all the guys all the guys on the desks, especially in the options and derivatives world, still get their shows via IM. It's amazing. It's antiquated technology that your Aunt Agnes might have used a decade ago. And yet these guys are getting size shows and conducting a lot of business on AIM. And these people have actually approached AOL to say, hey, you have this business that kind of fell in your lap. You do nothing to maintain it. If you actually maybe updated this product and actually put some security and some compliance safeguards into it, you would have control of the street. And yet they want no part of it for whatever reason. It's amazing. So AOL has businesses that are still falling into their laps, a decade after their prime, and yet they apparently don't need them.
It's because everybody uses AOL Instant Messenger on the street.
Yeah, it's amazing.
Because they did. It was like the first platform that was useful, and that boggles my mind. But
yeah, we've seen a lot of people spend a lot of money to try to unseat AOL, and all of them have failed. Pretty much that is the technology they want. That and the phone still dominate so much of the business, and I think people find that fascinating in an era when HFT is gobbling up the headlines and transactions are going up in milliseconds and microseconds, and yet these guys are still getting shows on AIM the old-fashioned way. It's amazing. So yes, anyway, AOL. Long story short, AOL still has a business. Whether they know it or not is another question entirely. Uncle Mike, we kind of jumped away from your stuff a little bit there. I know anything else going on in your day today you wanted to hit on, your daily Apple GLD rundown. What else is cooking over there?
No, nothing else to speak of for the most part. With that, in honor of the viceroy for right now, bonds did come down a little bit yesterday right after the announcement, which I would think it would, but they're coming up a little bit today. I'm just looking at TLT, the longer term. It's up about 36 cents on the day. Not a lot, but up 1/3%. And then IEF, the one that tracks the 7 to 10 year, it's down 7 pennies. So with that, bonds are stable for the time being, but they have come off their highs going into this announcement, and they could continue to go lower.
All right, with the viceroy gone, I declare a 6-week hiatus on all things fixed income. We'll get to that in a minute. Meanwhile, it's time for us to keep on rolling. Right on into our next segment. It's time for the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, that funky tune means it's time once again for the Odd Block, the portion of the show where we break down the weird, the wild, the interesting, the bizarre, sometimes head-scratching paper we're profiling over there at theoptionsinsider.com. I'm going to kick things off with a weird one. Uncle Mike, keep your listening ears on because this one is right up your alley. This one, the name is interesting, is Energy Transfer Partners LP, ticker symbol ETP. Closing today, $60.22, up about $1 or nearly 2%. This is the name that does about 2,000 contracts a day, doing 10x that, or a little more than 10x that, actually, 25,000, nearly 26,000 contracts today. So fairly robust day from an overall contract perspective. And what caught our eye today was activity out in the December expiration cycle. And this is what made me think of you, Uncle Mike Tusaw, is some weird, crazy upside paper to the tune of the D60s going up, when we profiled them this morning, 5,000 times for $1.40, and the D62 halves going up 5,000 times as well for 65 cents. As the day progressed, we saw another about 5,000 going up on the 60s to a tune of about 10,500, and about another 3,000 or so going up on the 62 halves to the tune of about 8,000 on about 4,500 contracts. Open interest on the 60s, negligible on the 62 halves. But what's interesting is that this wasn't a spread. This appears to be a straight up Tusaw style upside call, or actually at the money to upside call, stupid here. No stock going up anywhere near the deltas you'd need to hedge this. So this appears to be, like it looks like on the surface, opening crazy upside call stupid. Rock Lobster, I know you're champing at the bit, but before we dive to you, Uncle Mike, just reveal it to us here on the program. This was indeed you playing out here in ETP today, right?
Ask me no questions, I will tell you no lies. This one, I'm gonna cut in line a little bit today, just because it is the special trade of the stupid. Looking at this, I think that, is it possible that maybe he didn't feel there was enough volume at one strike price, so he decided to buy at multiple strike prices to create more volume?
Maybe. I don't. These stupids just flummox me. I don't really see a lot of intuitive logic behind them. That's why I've always said I kind of don't like them. I don't mind your Tusaw-esque rolling stupid, where you have some profits and you leg into the next strike, because you want to put some more on and maybe don't want to take off what you have, don't want to buy more, what you have is too expensive, whatever the case may be. That makes some intuitive sense to me. But just coming out with a straight up stupid, the only logic, and I use logic loosely in this terminology here, the only logic I've heard behind this is that some people think you can get off these types of trades. If you get them off simultaneously, you may minimize the market impact, because if you come in to buy 10,000 of the 60s, you're going to move that spread. Whereas if you try to hit the lifty offers on both simultaneously, you'll get less market impact on that. I don't really subscribe to that theory either. Market makers aren't stupid. Once you lift their offer for size on one of the strikes, they're adjusting pretty quick. So I don't think you're going to be able to take them by surprise, as it were, and try to sneak in another 5,000 because it's one strike higher. I don't think that really works that way. But c'est la vie, that's the only argument I've ever heard that makes even remote sense for why you'd come on and put a stupid on like this way. Mr. Andrew, what did you take about this? What did you think about, I should say, of this crazy upside call stupid here in ETP?
What I see, though, is somebody is buying, like, the best thing I can say when you buy calls is on the day you buy calls, out of the money calls that you're up big money on the first day. And at least from passing that sort of test, the guy paid $1.60, they're 190 bid, paid $1.40, they're 190 bid, paid 65, they're $1 bid. So he is, whoever it is, guy or girl, definitely not stupid buying this stupid. As far as market impact and all that, I think that's just all, realistically, I don't think it makes a whole hill of beans worth of difference. As like you said, liquidity providers, once they start getting lifted on one strike, they don't go, oh, okay, I'll just sell this other strike because I don't know what's going on in the other one. I mean, it just doesn't work like that. So maybe they think they're being sneaky, but right now, I think this customer hit the market with a sledgehammer of buying. Volatility is pretty darn high for this stock, or it's not even a stock. I guess it's a limited partnership type stock. And as of right now, they're right. I mean, prior to earnings, this is the highest fall we've seen in this name. So they're really looking for a big run in this name. That's all I can say. And that's a pretty big bet as well. So he might have traded as stupid, but right now he don't look stupid.
Yeah, buying a stupid, buying very inflated vol to the upside, usually all recipes for disaster. You combine all three into one trade, it seems like a certainty of disaster. At least yet in the opening blush here on this trade, it seems to be working out for them. This reminds me of the guy on the craps table who would bet big six and big eight or the hard ways and make a ton of money and make it look easy. And they'd drive me crazy. You're making a very bad bet over and over again, and yet it seems to be working for you in the short term. We'll see how this guy works out in the long term here. And you're right, I don't think you can game liquidity providers by doing stupids like this. You might be able to get a few hundred contracts maybe at that lower level, but then they're going to say, wait a minute, this is the same guy I just traded with 5 minutes ago. I'm not going to give him more contracts. I'm going to raise my level. So yeah, I think this is an interesting one. We'll file this and I'll mark it down right now. We'll file this in the to be watched category here to perhaps come back to on a future show. What the heck is going on with this upside stupid? Meanwhile, we're going to keep on rolling into our next name here. This is going back into the energy, the petroleum realm. In particular, this is Petroleo Brasilieiro Petrobras. This is, of course, an ADR. PBR is a ticker symbol. Closing today, $17.09, down about 3% on the day. And what we saw here was kind of like what we saw before, but taking a different spin on it. Instead of just buying that stupid, they went the old ratio route. In particular, looks like 1 by 2 here was the Nove 21-23 call spread going up for 8 cents 1 by 2. So they did it 9,800 by 19,600. Why can't they just do round numbers at that point? Do 10,000 by 20,000. Make our lives easier. I'm just putting it out there to all you unusual activity traders. Make the numbers round. Make our lives a lot easier here on the show. We'll certainly appreciate it. This is the name that does some paper, though. This is the name that does about 73,000 contracts a day. So fairly aggressive paper out here. Doing about 100,000 today, as you might imagine. A lot of that coming in this one trade. Nearly 30,000 contracts going up in this one trade. So that pretty much is your bump. 70,000 plus another 30,000. That's pretty much today's volume. So pretty much all the extra coming in this one trade. Let's roll out here to the November strikes. Let's see exactly what we're looking at here from an open interest perspective. Looking at these Nove 21s first, there's some size paper here. There's looks like about 36,000 open on this strike, and looks like about 45,000 open on the 23s. I should actually mention, some size open interest here on these strikes. So this could be a bit of an adjustment here. It could be closing as well, given all the open interest you see out here, but this is an interesting bet here if it is straight up as we see it on the surface. An interesting bet here on some pretty aggressive upside here. Gonna need some serious movement in PBR for this spread to really start making some cash. Mr. Rock Lobster, what's your take here on this 1 by 2 in PBR? Not Pabst Blue Ribbon, but your other favorite PBR.
Not the tasty frosty beverage, but a big barrel of yucky oil type.
Which I'm sure you had a good helping of PBR while you were in Chicago last week, just to feel at home. I mean, you're close to Milwaukee. You might as well make it happen, right?
We did have a couple of beers. Actually, I had a couple of beers while we were doing the show.
Yes, listeners, I'm sure would never have realized that. You were singing by the end of the show.
I was, and actually one of my clients bought me beers. Just say, oh, well, he's drinking one. Well, I'll buy him another one. So I don't think I ever went thirsty. As far as the PBR trade goes, definitely a name so basically, I think this is a play on, the election. PBR may be going to new highs, but they're not spending a lot of money on it. So they're looking kind of for an upside breakout. In the meantime, it doesn't do a whole lot, and they want volatility to come in as hard as possible on the rally, which, given the crazy implied volatility levels in the Brazilian equity markets right now, I think that's a reasonable bet. So, he could see a number right around there in November. I mean, it would be year highs for Petrobras, but that's kind of what they're looking for, because I believe they put this on for a small debit this morning, and normally that kind of breaks my rule. I don't like 1x2s I like this for debits. I like them for credits.
Yeah, that violates all that you hold dear, sir.
I know. So I saw it going up as a debit. I could have, been a total dunder on it, but I still believe it was a debit going up. So, that way, if the things just kind of fall apart, you don't have to really worry about it, because it's pretty sizable. 10 cents on or 8 cents on 10,000 contracts is not nothing. But they're obviously looking for a pretty good chunk of change on this one. So also, too, another thing, just with the big call stupid, I'm reminded that didn't Kinder Morgan have that reorg recently, and the stock kind of had that big gap. Maybe, I don't know if ETP, it is one of those partnerships, if that would qualify for that same type of reorg, because I don't think it's as complex as the Kinder Morgan kind of bunch of entities, but maybe that's something that's possible. But this, what this stupid buyer, not stupid buyer, is doing, I forgot to mention that.
I suppose that makes about as much sense as anything else when you're talking about putting up stupids like that. Interesting. We'll have to, like I said, we'll keep an eye on that one to see if it's something that does indeed occur in the underlying. For that guy's sake, I would hope so. Something big coming down the pike there for, what was that name again? That was ETP. But now we're moving on. It's just acronym city today, and a lot of them are confusing because we use them all the time, like ETP in other contexts. We're going to wrap things up here on the old Odd Block today, listeners, we got to touch on a cheapy bio. Wouldn't be the Odd Block without a cheapy biotech. This is PDL Biopharma Inc., ticker symbol PDLI, PDLI. This one not as cheap as the usual ones we talk about. This one almost $8, $7.89. They were north of $8 this morning. They sold off pretty aggressively today, down about 7%. So that's why they're south of $8 today. This is the name that usually does a whopping 300 contracts a day, doing over 8,000 today. And a lot of the love we saw, at least this morning on the old site, came into the tune of, surprise, surprise, some put action, some fairly heavy put action out here today because stock's selling off pretty aggressively. And it was put action in the October expiration cycle that caught our eye. When we highlighted it this morning, we saw paper buying about 400 of the OC8 puts for an even 50 cents. And then as the day went on, that went up in one block. Not surprisingly, it isn't a lot of contracts. But as the day went on, a lot more paper followed in behind to the tune of nearly 2,700 total on the strike. On open interest of just 300 some odd contracts. So clearly a lot of opening paper, and a lot of opening paper to the downside. What's interesting, though, is that even though the guy got his early kind off at 50 cents and a lot more went up behind him bidding these up, and the stock sold off, we still see these things offered at 50 cents out with the stock down about 7% today. So that's not perhaps a good sign that these are gonna work out too well for them. Even now, these puts are about 11 cents in the money. So we'll see how this works out for them. But interesting stuff here. We don't talk about a lot of puts in biotechs very often. Usually it's upside call palooza. So it's nice to see a little bit of a change of pace here, even if at least on the surface, these things are offered in their face, at least right now. Mr. Rock Lobster, take us home with this size put trade here in PDLI.
Yes, this PDLI stock dropped a bunch the day before from like the 9 handle down. So it's definitely, and it pays a dividend too. Have you ever heard of a biotech paying a dividend?
Yeah, that's like, all kinds of odd.
It's swirling my brain. Vol jumped up, and this is kind of, stock not looking good. Vol's up a lot, and people are piling in, buying these puts. looking for, a lot more downside here, which I don't know if they're going to get it, but that's what they're looking for. So again, the sniff test on buying premium the first day is did they make money on the first day when the stock did what they wanted it, when the stock did sort of what they wanted it to do. And apparently right now there is some supply at 50 cents. So there was an early buyer, and now somebody's saying, okay, you know what, 7.5 is good for me for this piddly stock. And that right now, I'd like our new phrase, the cage match is at 50 cents, at least as it stands.
Yeah, someone's saying, I'll sell these the whole way down to you, 50 cents all day long, essentially.
Yep, like you can have them. So we'll see what happens. But, I mean, the underlying does pay a divvy. I don't know what if there's been a major change, but, they pay a 60-cent dividend a year. So that's not nothing on a $7.89 stock. So, maybe that 50-cent put sale, unless there's a marked change in something, somebody's doing a little scooping.
Yeah, could be interesting stuff. Again, this is probably another one we're going to file in the to be watched category. Meanwhile, listeners, we've been doing a lot of odd blocking. It's time for us to roll on into your portion of the show. It's time to open up the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, welcome to the Mail Block. This is indeed the portion of the show where you guys get to sound off and join us here on the old All-Star panel, make your questions and comments heard and known to your fellow listeners. No shortage of ways for you guys to do that, including surfing on over to the mothership, theoptionsinsider.com, and posting some comments or some feedback questions there through the website. You can also do it via social media, twitter.com/options, facebook.com/theoptionsinsider, or you can even use our mobile app to do all that stuff and make it even easier for yourself. Or, of course, I even neglected to mention the old-fashioned way, email, just put in the subject line, question for the option block, so we know where to direct your question. And today's question, we have a bunch of them, but I don't think we're going to get beyond this one, because this one's pretty epic. I tried to bring it up last week on the live show, but we just didn't have time for it. He's been waiting patiently for his answer. This is the guy who's a big fan of the show, writes in every now and then. This is Dr. Larry, and he writes, "Hi, Dr. Larry back again. Thanks for reading and answering my previous 2 questions, comments on the show. I'm a huge fan. I'm considering a way to insure my bond portfolio with options." So here we go, guys. After I said there's a hiatus on fixed income talk on the show here, Dr. Larry throws a wrench in the work. So put your bond hats on, guys, because this is going to be deep into the bond woods. He goes on to write, "Honestly, I'm not too concerned with rising interest rates in the next 2 to 3 years, but I understand the risk exists. Additionally, a market crash seems like a bigger risk to me. Either way, I see bonds having downside risk. Here's my thought process below. I'd love to hear you people comment. Situation. I'm about 8 to 10 years from retirement. I have about 80% of my savings in just below investment grade bonds. These are big companies like Goodyear, Burger King, US Steel, Morgan Stanley, Levi's, Hertz, Ford, etc. It's a very diverse bond ladder, I would say. Doc, it's a pretty diverse group. Average return is just under 7%. They've appreciated a great deal over past 8 to 9 years too. By Rule 72, I'm doubling my money every 10 to 11 years with interest, hopefully faster with appreciation of the bonds too. The risk is if there is a period of rising rates, although I plan to hold to maturity, or a market crash like what happened in 2008. I was considering insuring this portfolio with LEAPS in HYG. That is, of course, a high-yield bond ETF. It appears to be the most liquid options compared to other similar bond ETFs. As for stock volume, it's second only to JNK. I can buy the Jan 16 puts at the money pretty cheap. These LEAPs are trading less than a 10% implied volatility. In the 2008 crash, HYG went from 105 to 65, and implied vol went from about 10 to about 22%. I did not want to just buy the puts naked, but was looking at back spreads. This way I'm selling premium to get much less short theta, and I'm buying more puts to get long vega and short delta. The best spread, take another breath here, this one keeps going. The best spread I found was a Jan 16 put back spread 1x4. Short 185 put for each long 470 puts. With theoretical pricing, I can put the spread on for even money and possibly even a dime credit. I can see Andrew's light bulb's going off. He's excited by that. I'd close this spread when the Jan 17 LEAPs are listed and add 12 more months of insurance. In summary, I have some upside risk as the implied vol can go down to around 5% based on history, but that's the cost of my insurance. When I roll to Jan 17, I'd likely lose some money. Questions. 1, how do I weight a bond portfolio to figure out how many contracts to trade? 2, similarly, how do I estimate downside risk of the bonds? 3, is HYG my best underlying? 4, is there a different spread that's long vega and short delta that you recommend? 5, would you use a diagonal instead of trading only 1 month? I can get similar protection by trading at 1x2 diagonal, short 1 Dece 90 put for each long 2 Jan 2016 85 puts for around even money. I can then sell more, he writes 90 or other strike puts when the Decembers expire. My hesitation here is that it's harder to predict the IV of 2 months. I think the short Dece will increase implied vol in a crash more than my long Jan 16 and hurt performance. If you read this long question on the air, I'd really appreciate Dr. Larry. Well, I hope you appreciate that, Dr. Larry, because I'm pretty much out of wind at this point. That was an epic question. Uncle Mike, save me. I can no longer speak. What do you have to say here for our friend, Doc Larry?
All right. Well, first off, Doc Larry, I think you've definitely put a lot of time into this, and I think that's a good thing. A couple of thoughts that I would have on this. I want to start by just telling a story from 2008, and I can't take credit for this trade. This one is the big boss himself, Mike Cavanaugh, did this for some clients back in the day. GE had some bonds that were trading around 72, and their maturity was probably about 4 or 5 years. I forget what it was. And so in looking at it, it wasn't because of rising interest rates that GE's bonds were so down. It was just because of a lot of fear. And so what had happened is that there was so much fear in 2008 that everyone was just taking money out of everything. And so GE is something that was recognized as an opportunity, and that if you buy them at a discount at 72, for those of you that don't quite understand bond pricing, if you hold them to maturity, they'll be at 100 at maturity. So by doing that and holding the GE bonds for, I believe it was 4 or 5 years out, the bonds themselves, you could buy at 72, they mature at 100, and over the course of 4 or 5 years, it's not exactly a bad rate of return, combined with the fact that you're getting some interest payments there in the meantime. So what would happen is that you're looking to see what's the main risk of buying these GE bonds. Well, of course, rising interest rates are definitely a risk, but if you hold these till maturity, then that risk generally isn't there. So to parallel that to your question, Dr. Larry, if you're planning on holding these bonds till maturity, then the rising interest rates, even if we do raise rates over the next couple of years, which I agree with you, I really don't see it happening too significantly myself either. But even if we do, then it's not an issue to you because if you plan on holding the bonds till maturity. Now, the issue, of course, is the companies, in that if they go bankrupt, then you lose all your money. That's the bottom line as to what you need to worry about. So at this stage, a couple things that I would recommend looking at when looking to hedge this bond portfolio based upon the integrity of these companies. First off, I don't know if I would necessarily go the JNK or HYLD route because of the fact that, and this is maybe you look this up and you find something otherwise, within those bonds, are they holding the same bonds with which you have? One thing that I'm not a huge fan of is using, let's say, buying calls on the VIX to hedge your S&P mutual funds or your SPY long-term holding positions. As a short-term trade, hey, great, I think it's a wonderful thing. But if you're using the VIX to hedge your S&P positions for the long term, I've said it before and I'll say it again, it's like buying car insurance on your house. So in this case, what I would do is make sure that your bonds themselves mimic the movement of HYLD or JNK. And on top of that, see if maybe HYLD or JNK has some of those bonds within their the ETF itself. Now, in terms of what you should buy to hedge your positions in case of the company's defaulting, I think you need to determine, of that 7%, how much of that are you willing to give up? If you're currently yielding about 7% a year, and let's just assume that you bought all the bonds right at par and they're going to stay at par, just to keep this simple, meaning you bought all the bonds right at 100 and they're going to mature at the same level. There's no premium bonds, there's no discount bonds. With that being the case, how much of that 7% are you willing to give up to take on the protection? Are you willing to only have a 5% yield but have some protection in place? Are you willing to have a 6% yield? And then at that stage, you need to figure out what is the strategy of choice. Ultimately, Larry, let's say that you're willing to take on a 6% risk every year or give up 6% of it, then heck, I would just say buy the long puts and then call it a day. But if you're not willing to give up quite as much, at that stage, you need to get a little bit more creative with what you're looking to do. Ideally, if you had millions and millions of dollars in this portfolio, I would suggest that you use each individual stock's puts for each individual bond. I think that would make the most sense, and that's the only thing that will give you a true hedge. Now, let's take this to the next level. Do we sell premium to finance the long puts, or do we buy premium to finance the long puts? Well, if you're selling premium to buy the long puts or to finance the cost of the long puts, I think what would make the most sense, or what I prefer to use typically in situations like this, is go with a longer dated option and then perhaps use a credit spread or a put. Let's say you're buying a 2-year out long put to finance them week in, month out. I would suggest using other short put spreads as a means of financing it. Yeah, it'll take a little bit of extra money on it, but there's always a price for financing somewhere. Now, the other route you could go if you're looking to have premium finance, shorter dated options finance the longer dated long puts would be to possibly sell some calls. Now, you can sell the calls naked, but remember, if the value of those bonds goes higher and the value of those stocks go higher, it might not be the exact correlation with which you're looking for. So you may want to sell shorter dated call spreads. Now, what if the stock goes higher and then the bonds stay at the same level? Don't know if that's the ideal way with which you want to go, because then your hedge is costing you a lot of money when the bond isn't really using it at that stage. So I think what would make the most sense is if you're using longer dated put options to hedge against some type of a major bankruptcy, in the near term, maybe sell a few put spreads. I don't know if I would necessarily want to use a back spread for hedging, although I have done that in the past. But when I've used a back spread for hedging and like to use a back spread for hedging, a lot of times that's on Apple going into earnings. And so unless you're expecting a lot of movement in the near term on the stock price of some of these bonds, I don't think that would be an ideal situation, because of the fact that, let's say that you use the individual stocks, or even if you decide to go the J&K or HYLD route, if you decide to go that route and you get absolutely no movement, not only are you giving up premium on the long puts, but you're also going to be giving up the premium on the long calls, or the other angle or the other area of this back spread with which you're setting up, depending on how you want to set up the spread. So, Dr. Larry, hopefully that answers your question. And if it does not, or you have a few more questions on it, feel free to give me a call. I'll say my number at the end of the show.
Yeah, I probably want to sit down with someone on this one, because this is a very intricate dilemma. I kind of agree with you, Uncle Mike. Just for the record, by the way, he's talking HYG, not HYLD. Similar beasts there, though. HYG, at least I can see why he went to it from an options perspective. It is one of the more liquid ones. So from an options liquidity standpoint, it is one of the more attractive names, but I kind of agree with you. I'm not sure if the correlation to his underlyings are really there. He said he was talking mid-grade for his portfolio, whereas this is pretty much high yields. I'm not sure if the correlation to serve as a hedge is really there in this underlying. And also, what you're talking about, Uncle Mike, he'll definitely need to finance this protection. He was talking about the Jan 2016 93 puts. So this stock right now, HYG, trading exactly $93. The 93 puts are trading essentially $9.30. So he's talking at a 10% annual outlay here, or a little bit over annual at this point, a year and a change to cost to hedge this position. He's only bringing in, I think, 7% on their portfolio. He's definitely going to need to actively sell some premium to make this even remotely worth his while. And that said, that's for what we think is going to be a substandard hedge at the end of the day. So I don't know if that's really worth all your time and effort here, Mr. or Dr. Larry, to do all this work and sell all this premium for a hedge that may not suit you that well at the end of the day. I think the top question is also probably one of the more tricky ones, is really how do you weight a bond portfolio to figure out how many contracts to trade. We see good tools to help you do this on the equity side of the fence. We talked about this a lot of times before on the show. You have an IRA and you want to hedge it in your trading account. How do you calculate what your actual beta is and things like that, and how many shares of SPY or SPX you actually hold, and therefore how many puts you need to buy. There's a lot of tools that brokerage firms have to make that process much easier and much less painful for you. Not so much on the fixed income side. I mean, I don't know what broker you have. Maybe you do have Options Express. I don't know, in which case you should contact them and ask them exactly how they recommend you get that exact number. Maybe you have a broker that's a little bit more experienced in fixed income, they can help you with that as well. That's probably be one of the biggest problems, is finding the accurate tools to do that yourself. And I would definitely lean with Uncle Mike that not a huge fan of HYG. That said, I'm not sure if I have a better alternative for you off the top of my head of just reading your question. It might require a little bit more mulling, but it is an interesting one. Andrew, anything else here you want to add here to our friend Dr. Larry? Certainly an elaborate question. Certainly we could spend a lot of time on it, but anything you want to talk about in terms of either the strategy or the underlying, or perhaps the tools, or any of the other myriad questions he's asking here?
The only thing I think I kind of agree with Mike. If you trade the HYG, it's more like trying to add alpha trade than a hedge, a clean hedge.
Yeah, this isn't really a hedge.
The second one is, if he's worried about, the only way they're not paying those bonds is if really the company goes through bankruptcy, right? Because that, I would guess, just from these type of corporate bonds, they're probably kind of senior. Would be senior liens and stuff like that. So if the company goes bankrupt, then they're not paying, and then you have to go through the bankruptcy process. So, if you really look at it, you're kind of looking at buying like bankruptcy puts, which generally kind of like junky little out of the money puts, where, if the stock really suffers a huge reverse, you kind of want to own those. And that's, I think, might be a better hedge for something like that, because that's really what you're trying to, you're trying to hedge really bankruptcy, because if GE just has a couple bad quarters, it's not going to affect the bonds a whole lot. So if GE goes bankrupt, then you have to wait in line, but then the equity value goes to nothing. So you're definitely looking more like just, a little bit more junky, long-term out of the money puts. I guess, you're mentioning a CDS. Like a CDS would be a direct type hedge, but the cost, I would guess, for what you want to do would be, they would probably write a CDS for you, but I would think that is not going to be a very cheap product.
Yeah, he'd probably be in the same realm as what he's looking at for HYG puts. But that is more of an option for retail, pun intended, than it ever was before. We're seeing CDSs being brought onto centrally cleared platforms. You don't really have to go OTC and call up Goldman and ask them to create a product for you as much. You still have to do that to some degree, but it's much more liquid and viable for even a guy like a retail customer here than it would have been a few years ago. I'm not saying I recommend that route, but it is one option, pun intended, that he could look into and maybe talk to his broker about. If he has a sizable enough portfolio, maybe it is worth having a few of those that are more direct protection on exactly what he's worried about, default on these names.
Yeah, I agree. But still, I mean, again, cost-wise and all that, you don't want the hedges to cost you an arm and a leg. So, I mean, at this point, he's sowing the money on these. It just depends on, he's got a good capital gain and everything else. They're trading at a premium. Obviously, that premium, the bonds eventually go to par, right? So I don't know when at some point, it's done paying coupons and stuff like that. So I'm not much of a bond trader, but I do like the idea of just keeping the hedge kind of clean like that.
Why did this question have to come in when Alex is on extended hiatus? This would have been right up his alley with all of his love of the 10-year and all things bond, unfortunately, including the SPY. Great question, Dr. Larry. That's a pretty intense question. We might have more to discuss about that in coming shows, because there's a lot of different moving parts to that, and kind of hard to squeeze it all into just a 10 to 15 minute segment. I hope we at least got you pointed in the right direction and perhaps away from some of the wrong directions, or potentially wrong directions, that you were leaning in. I could see why you were going this way. There's nothing bad about it. It's just maybe not going to give you the bang for the buck that you want. But I'd be curious. I might want to look into this on the other side of this and just how much it would cost on the CDS side to see if that is something that's becoming a little bit more viable. I think Andrew's right. It still will be more expensive than the listed stuff, but it might be an interesting exercise to see how much these things have come down as they've gotten more liquid and there's more access to clearing and things for these sorts of products. And maybe down the road that will be a viable recommendation for someone like a listener of this program. They can just go on a listed centrally cleared platform and say, I want to buy some CDSs on Ford or whatever the case may be. And it'll be something that's easy and viable to them as opposed to the difficult hurdles that are in front of that now. Unfortunately, that's all the time we have for the mail block, as you might imagine, listeners. That's also pretty much all the time we have for this episode of the Option Block. It was a mega listener mail, but we love when you guys write in with great questions. We want to make sure you guys get your time on the show, because after all, it's about you guys. And for those of you who couldn't make it live in Chicago last week, this is the next best thing, giving you some time on the old program. So before we go, as always, let me check in with each of my cohorts here, my partners in crime on the old program, to see what they're cooking up that may interest you. Starting with you, Mr. Andrew, what's coming up in the land of the pit, sir?
Our big webinar next week, September 24th on Wednesday. We unlock the secrets of the mysterious VIX. And the VIX ETPs, showing kind of how we trade them, how we look at them, and how somebody like Mr. Tucson could say, well, that's kind of insuring a house versus insuring a car, and get people to understand what the product actually does. So the best way to understand is take a class by us, which costs how much, what is Mr. Tucson's favorite amount for a webinar? Oh, that's right, free. So we have a free webinar on the 24th, and we have a more in-depth webinar after that on October 6th that you will have to pay for. But I guarantee that you will, by taking our webinars in general, people save the money on boo-boos they would have cost them multiples of what our webinars cost. So
there you
stop
go.
on by, and we'll be happy. Sign up at optionpit.com/events.
We like free here on the old network. Thank you for that, sir. You're now free to go back to fishing and whatever else it is you guys do over there.
No fishing tonight, clients.
All right, sir.
All right, see you guys later.
And Uncle Mike, I do agree with you. I think our friend Doc Larry might want to give you a call, as well as some of our other clients who are interested in things like this. Maybe you two can put your heads together and try to figure out exactly what would be a suitable hedge for a portfolio like that. And maybe you could even price up some CDSs and see how they compare and contrast to doing something like the back spreads in HYG, or perhaps doing something in the individual names like Ford and the others. That would, of course, get pretty expensive pretty quick as well. So a lot of interesting things to discuss there. Uncle Mike, if someone wants to find out more about what you guys are doing, wants to reach out to you over there at RCM, how should they do it?
Well, by all means, feel free to send me an email or give me a call directly, 312-212-3531, or feel free to send me an email at mtusa@rcmam.com, and I'll be happy to chat with anyone on such matters.
All right, listeners, you heard them. So if you too have an elaborate question that won't perhaps fit into an aired episode of the Option Block, go ahead and send it over to Uncle Mike Tusa. He's free and very happy to spend the time to find the answer for you. And on behalf of Uncle Mike and the Rock Lobster, and of course myself, and indeed the Viceroy, who will be back with us shortly, I want to thank all of you out there for downloading and streaming and subscribing to the show, and of course, for sending in such great questions. Keep them coming. Maybe not quite as epic, even though we do like the epic questions every now and then as well. So keep those coming as well. And we'll see you next time right here on the Option Block.
The Option Block was brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA. The
preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.